Let's do a primer on borrowing money for leverage. Hey, this is Justin Hitt with Sustainable Wealth Secrets. Right now, the Federal Reserve has lowered interest rates so low that, how low is it? Well, you can get mortgages for 3%, 4% with good credit. There's also the COVID-19 related loans. There's also all kinds of provisions to access your 401k, to access different savings accounts. There's even lines of credit available from the government. I know one business owner who got $400,000 of federal money lent to them for their business, in which the plan is to use it to displace cash flow in order to buy other businesses. But there's some things you have to consider. When you have a portfolio of debt, you need to know your cost of capital, because a 5.25% loan, when you already have a 6% cost of capital, may not produce the value that you want if you've got closing costs, if you've got heavy restrictions on how the money can be used, or if you've got other compliance-related efforts that add additional overhead to your activities. If you need to borrow $10,000 for your business and you borrow just $10,000 without considering how that impacts your payments, how that impacts your overhead, how that impacts your reporting or tax position, then you could be in a position where you maybe should have borrowed $12,000 instead of $9,000, so you can cover some of your expenses. If you're in a situation where you have $5,600 in payments every month, and you could borrow and reduce your payments to $1,200 a month, because again, we could have changed the term, we could have changed the type of money that you're borrowing. It could be borrowing inside of a business versus outside of a business. Well, that $5,600 a month versus $1,200 a month, it wouldn't matter what the interest rate is, because from a cash flow perspective, you've generated additional cash, which you can then use some variety to offset and make principal payments on the loan. Maybe you borrow money from one plan at a low interest rate, use it to buy property that cash flows, so that even though your payments go up every month, your net payment goes down. And that could be the difference between that $5,600 a month in payments versus a $1,200 a month in payments, rather than just the terms. You could be buying something that cash flows, and the net cash obligation or debt obligation is actually $1,200 because you're receiving $5,000 a month in income. There's a lot of numbers you got to look at. And the biggest challenge I see people making, especially high-income professionals, is thinking that their income sources will continue. If you're going to borrow money, the best place to borrow money is in positions that leverage and produce additional net free cash flow, and positions that secure income streams, because multiple income streams gives you stability. Assets that are significantly discounted. I'm looking at a property and they're listing it at $280,000. It has $12,000 a year in cash flow. If I could get that property for under $200,000, which I may not bother to ask, but I could if I had it under $200,000. I could have the cash flow from the property pay for itself. The only challenge there is it probably has 5 to 10 hours a week of maintenance that would be required for this particular type of property. But the point is that there's opportunities out there, and what do you do to benefit from these opportunities in a world where the government is giving away money? Now, often the government is not really giving away money. It could be a ploy for mass control. It could be a ploy for, they're having unintended consequences. They're awarding money and giving people cash, savings rates up to 30%, and then suddenly people go into the market and they speculate in stocks, and there's a stock market bubble, or they buy up consumer goods and end up sending all that money to China or to other types of countries that don't have our interests in mind. Ultimately, the government money has unintended consequences, no matter how free it might be. Every money borrowed has unintended consequences, no matter how much you pay or how little you pay for that money. But you can mitigate your costs like we do when we talk about having an asset pay for itself. So I have a program that goes into details about this, but we would develop a model for every purchase. You don't just go out and refinance your house. You have to look at what your fees and costs might be. Are there any maintenance and repairs that would impact the value of that home? What would your payments be before and after the refinance? And it's not just lowering the payments. What would your interest rate be? What would your opportunity be as far as the impact on equity of the property? Is the property a rental property or a personal residence property? What's the difference between that? I've seen people who refinance their home and then turn around and lease the home out while they downsize and get a smaller place or an apartment, and they actually had unintended consequences of the loan revaluing and increasing its interest rate, which then made the loan cost more than the cash flow they're producing on the rental of the property, and then they go negative every month. Now, in their particular case, they were only negative about $300 to $400 a month, so it wasn't that big of a deal. But having someone renting the larger home while they were off in another city living in an apartment, there was a job relocation, long story short, wasn't a big deal because they intended to come back to that home later. So the improvements and the investments and the changes in the property were actually a long-term benefit to them. But that's what you put in the model. The model's going to address inflows, outflows, capital expenditures, what might impact the value of that asset over time, whether it's an asset or a liability. I recently bought a truck that the day I signed the papers on that truck and drove it off the lot, I could have drove it to the nearest city and traded it in with a Blue Book value higher than the loan value or the total price on that invoice immediately. I could have just simply drove it down and sold it and got cash in my pocket. Now, I needed the truck and I wanted to use the truck for other things. And so by getting the truck, I was able to apply that resource. It's not an asset. It's just a resource. And in fact, it's a liability, but I could apply that to the different areas where I could use a truck. Same thing would go with your home. You could refinance your home, cash out of your home, turn it into a rental. But again, you'd have to live someplace else. So your model would look at what are your costs? What is the asset value? What's the impact of that asset? What if 2 years down the line, the economy changes? So right now, money's you're giving money away. If you have reasonably good credit, you can get a loan. But then again, will you have the same income in 6 months, 1 year, 2 years, 3 years? Is your income going to go up? Well, we all dream and wish our income would go up, so we should discount that estimate. But more likely your income will go down because the cost of living will increase and inflation will impact your earnings. Right now, we're in a situation where while the Fed is giving away money to businesses and while large businesses are flush with cash and they're just got huge coffers of cash, nearly every publicly traded company is talking about the potential to lay off individuals. Why is that? Well, they've just had many months of people working from home and some people not working at all. They've been able to furlough people and notice that there's been no direct impact on their revenues and no direct impact on their overall business outcomes. So they're able to be in a position where they can people are not essential. There's been other cases where people have been laid off and they've not been able to produce the goods that are necessary to sell in the marketplace to recover the money to pay the payrolls. So they may have to go to a skeleton crew. So if you think you're going to make the same money in 6 months that you make now, or even 2 years from now that you make today, then you've got another thing coming, because what a lot of companies are going to end up doing is laying off huge groups of people and then just hiring them back at a lower wage. And it's going to happen across the board, including in the six-figure world, so that the company can then lower its costs. Well, if you're running your personal finances, your estate finances, your family office finances like a business, where can you reduce costs now, cut costs hard, use the borrowed funds to position yourself so that when you come back in to the marketplace, you can hire people at lower rates. You can hire equipment instead of people. You can transition to a different type of business. I know a couple of folks who have restaurants, and it was cheaper for them to go ahead and just shut down the restaurant completely, go on a holiday. And they went to their little mountain cabin, got away from all the COVID issues, let the restaurant sit idle for a couple months. In fact, they cleaned everything really good. They shut down the equipment, drained out the washers for the dishwashing machines. They drained that all out. They cleaned the grease traps out. They emptied the refrigerators out. They cleaned and sterilized all the refrigerators, unplugged everything, shut everything down, and they wrapped that business up for 6 months while they went off someplace else. Now, they went off someplace else to fill out loan applications so they can get money for the business, but they had a really tightly run business that when everything comes back online, they're going to have enough cash flow to cover these loans. Now, here's something about these COVID loans that you may not have considered is the government is loaning money to businesses that had zero income to cover payroll for people who would normally have been laid off otherwise. If the government didn't bail it out, they would have been laid off and potentially found other work in the marketplace. But these folks have been sitting at home, spending a lot of that money, saving most of it. But ultimately, will those employees want to come back to work? See, the government's even floated an incentive to go back to work. Meanwhile, all of us high-income people have been working our asses off and working remotely and taking risks to solve problems for people, even though, we're supposed to be staying inside. But these folks, will they go back to work? So can that business that was idle for 6 months come back online? And will customers want to come back to that business? See, that's another thing, too, is the spending habits of individuals are going to impact your income. So we build these out into models and scenarios. There are general models that we talk about. And as I've mentioned in programs before, I've done cost modeling for $10 million programs, $30 million programs, as well as buying a truck. I actually drew up a 2-page cost model on buying a truck and determined that buying a brand new truck in 10 years, I'll have greater asset value than buying a used truck, even though the used truck costs significantly less to purchase. It may have, according to Blue Book, and there's resources you can look at, it may have higher maintenance costs that would cause me to have a higher expense over time. Using the expenses to discount the value of the asset on resale, I would have better asset value and potentially the same costs buying a new vehicle versus buying an old vehicle. Plus, my new vehicle would have been hedged by an insurance policy, and buying a new vehicle of this particular type is easier to justify as a business expense because of the nature of the vehicle. But long story short, how do you start building your model? First off, you must know and have a clear catalog of all your debts and assets. We talk about this in a cash management system. We talk about this in debt management, the method. By having an inventory of all of your assets and liabilities beyond your balance sheet, you will then know how much is the obligation on each of those or the potential earning on each of those. I know that despite the stock market crashing, I still made 1% on my portfolio. Now, I was down as far as 8%, but I've heard other people down 40%, 50% or more. And ultimately, I was only down 1%. But if I can borrow money at 3%, I can't go put it in that fund because there's no guarantee that I'm going to have a higher than 3% yield. If I'm having to use credit cards at 26%, that has a higher obligation or a higher interest or cost of capital than if I'm refinancing a house that might allow me to have a mortgage, which would have low cash flow demand, but a lower interest rate over time. These things are critical, and I can help you sit down with a cost model specific to your situation. Now, I'd prefer to do this if you're buying a $500,000 piece of investment property or a business or buying something that's going to cash flow, because the ideal situation is you borrow $100,000 and let's say you have an $80,000 loan with a $1,500 a month payment. It's a 5-year loan. And that $80,000 goes into an asset or controls an asset that cash flows and produces $2,000 a month in net cash flow. See, that's the ideal situation, that your net is still positive. But my point being is that it's a very simple thing of sitting down, inventorying what you have, understanding the cost and the cost basis of these items. So you will want to know what you can liquidate for. And then finally, looking at what options are available in the marketplace. This is when you go out and meet with bankers. This is when you go out and meet with investors. This is when you go out and meet with business partners, and you devise a plan, which is built on your cost model, to not only acquire the asset, but to cash flow it. And then if it works out well, smart people and smart money are attracted to smart plans, and you have the skills to implement it, you'll ultimately come out ahead. And it wouldn't matter whether the interest rate is 10% prime or 0% prime, you'll still come out ahead using cost models. So that's the power of what I wanted to share today. I'm Justin Hitt with Sustainable Wealth Secrets. Visit me at www.sustainablewealthsecrets.com if you have questions about the programs that we cover, especially debt management right now and whether you should borrow or not borrow. And if you have a specific opportunity in front of you today to purchase something, there are millions and millions of dollars available. You can get combinations of federal funded loans. You can get commercial loans, local loans. You can get all kinds of loans. Now, I'm not a loan broker, but I do help with the financial cost models associated with a significant purchase. Even if you're just buying a piece of land that you want to cash flow, ultimately I can help you with that. Invest in a paid consultation to get you started. Thanks for listening. Again, I'm Justin Hitt with Sustainable Wealth Secrets.